Welcome to Portfolio Casts, the podcast where we break down real investor portfolios using publicly available data.
In this episode, we're analyzing Lilu from Himalaya Capital Management, based on their latest reported 13F filing, exploring the key holdings, portfolio concentration, and what the positioning might tell us about their thinking.
Mike, we are looking at one of the most concentrated portfolios in the hedge fund world today. Lilu and Himalaya Capital Management are running $3.5 billion. But they aren't spreading it thin. They are betting big on just a handful of names.
It is the classic Charlie Munger approach, Sarah. Lilu doesn't believe in diversification for the sake of it. He wants to own exceptional businesses at a discount. Right now, his top 3 holdings make up more than half of the entire $3.5 billion fund.
Let's talk about the heavy hitter here. Alphabet is essentially his entire world right now. If you combine the Class A and Class C shares, it is over 37% of the portfolio. That is a massive commitment to a single company.
It really is. He has about $818 million in the Class A shares, which is the Google ticker. Then he has another $789 million in the Class C shares under GOOG. Together, that is $1.5 billion sitting in one tech giant.
And he hasn't touched them lately, right? No buying or selling in the most recent filings.
Exactly. He is sitting tight. This is a buy and hold masterclass. Even with the stock down about 2.4% today, his overall position is up more than 32%. He bought in at a much better cost basis than the current $322 price points.
The valuation is interesting here. A price-to-earnings ratio of 31.6. For a value investor like Lilu, does that feel a bit high?
It might seem high to a traditionalist, but look at the earnings per share of $10. Alphabet is a cash flow machine. They even started paying a small dividend of 25 cents per share. That yield is only 0.25%. However, it signals a shift in how the company views its capital.
The stock has had a wild year though. The 52-week range is huge. It went from a low of $140.53 all the way up to $340.49.
It has been a volatile ride. But Lilu is looking past the noise. He sees the durable competitive advantage in search and cloud. Even with recent headlines about Rivian or other tech distractions, he stays focused on the core Google business. He is holding over 5 million total shares between the two classes.
That is a lot of eggs in one basket. But let's look at his second favorite child. Bank of America makes up 16.7% of the portfolio. That is over $543 million.
This is where the Munger influence really shines. Lilu loves big banks with massive moats. Bank of America is trading at $52.10 right now. The PE ratio is much lower than Alphabet at 12.7.
It is a much slower mover though. The overall gain on this position is only about 1%. Compare that to the 32% he is seeing in Alphabet. Is he losing patience?
I don't think patience is a problem for Lilu. He is collecting a 2.11% dividend yield while he waits. That is a solid $2.11 per share annually. With over 10 million shares, the dividend checks alone are significant for the fund.
There has been some news lately regarding Bank of America. CTO Brian Moynihan has been vocal about stablecoins and the risk of deposit flight. Does that macro concern change the thesis?
It adds a layer of risk. Moynihan mentioned a $6 trillion deposit flight risk in the broader system. But Bank of America is a too-big-to-fail institution. Lilu likely views it as a fortress. The 52-week low is $33.06. It has recovered nicely to the $52 level.
Even with those gains, the portfolio took a hit today. It is down 4.49%. That is a big daily swing for a $3.5 billion fund.
That is the price you pay for concentration. When Alphabet and Bank of America both trade down, the whole portfolio feels the pain. Alphabet dropped about 2.5% today. Bank of America dropped 1.6%.
But he hasn't trimmed a single share. He is keeping 10.4 million shares of Bank of America. He is keeping nearly 5 million shares of Alphabet. He is clearly comfortable with the current volatility.
He is looking at the intrinsic value. For Bank of America, the earnings per share is $4.01. He sees a stable, profitable business that is central to the American economy. He isn't worried about a 2% daily drop.
It is fascinating to see the contrast. You have the high-growth, high-PE tech giant in Alphabet. Then you have the bedrock financial institution in Bank of America. It represents two different pillars of his strategy.
And they are both core holdings. These aren't speculative plays. He has hundreds of millions of dollars tied up in these names. He hasn't added to them recently because they have already run up. But he isn't selling because he still sees long-term upside.
The total portfolio gain of 7.9% seems modest compared to the S&P 500 lately. Is the concentration working against him?
In the short term, maybe. But Lai Lu doesn't measure success in weeks or months. He is looking for a decade of outperformance. He is betting that Alphabet's AI dominance and Bank of America's scale will eventually pull that 7.9% much higher.
The Alphabet position is just so dominant. 818 million in Class A. 789 million in Class C. If Google has a bad year, Himalaya Capital has a bad year.
That is the definition of high-conviction investing. He is putting his money where his mouth is. He is backing the management teams and the business models completely.
It takes a lot of discipline to cede a 4% daily loss and not touch the sell button. Especially when you are managing billions of dollars for other people.
That is why he is one of the greats. He trusts his fundamental research. He knows these companies inside and out. He isn't trading the chart. He is owning the business.
Mike, we just finished talking about the heavy hitters in Alphabet. But let's look at the other massive pillar of this portfolio. Lai Lu has nearly 19% of his entire fund in PDD holdings. That is over $481 million in just one Chinese e-commerce company.
It's a huge bet, Sarah. Especially when you see that the position is currently down 21% overall. PDD is trading around $104.46 right now. But look at the valuation. The price-to-earnings ratio is sitting at a 10.1. For a high-growth tech company, that is incredibly low.
It really shows that value mindset. He's buying growth at a discount. Even with the stock down over 2% today, the news shows the broader Chinese market is waking up. The Mackay Index recently soared 45%. Do you think he's just waiting for the market to catch up to the fundamentals?
Exactly. The earnings per share are over $17. The 52-week range is wide, between $87 and $139. He's holding steady with 4.6 million shares. No recent changes here. He is clearly comfortable sitting through the volatility to capture that long-term upside.
Speaking of comfort, we have to talk about Berkshire Hathaway. It's his second largest position in this group at 14%. He's holding about $435 million worth of the Class B shares.
This is the ultimate circle of competence play. Lai Lu was famously close with Charlie Munger. It makes total sense he'd have a massive chunk of the portfolio here. The stock is at $485.39. It's a very reasonable 15.5 P/E ratio.
It's interesting that even Berkshire is down about 3.5% for him overall. But it's such a stable bedrock for a $3.5 billion portfolio.
It really is. And it provides a nice contrast to his next position, East West Bancorp. That's about 9.2% of the portfolio, worth $310 million. This is actually one of his winners, up over 5%.
I noticed the dividend there too. A 2.08% yield. That's a nice bit of income while he waits for the thesis to play out.
East West is a unique bank. They specialize in trade between the US and Greater China. It fits Lai Lu's expertise perfectly. The stock is trading at $112, right near the top of its 52-week high of $119. With a PE of 12.6, it still looks like a classic value pick.
Now, Mike, the portfolio gets a bit thinner as we move down. He has a 2.1% stake in Occidental Petroleum. That's about $61 million. Why such a small position compared to the others?
It's likely a tactical play. We know Warren Buffett has been buying Occidental aggressively. Lai Lu might be following that lead but with less conviction than his core tech and bank holdings. It's trading at $42.24. He's actually down about 10% on this one. The energy sector has been tough lately.
And then there's Apple. This surprised me. It's only 0.9% of the portfolio. Just $27 million. For most funds, Apple is a top holding. Here, it's almost an afterthought.
It really is. He only holds about 110,000 shares. It's trading at $246.70 with a much higher PE of nearly 33. To a deep value investor like Lai Lu, Apple might just look too expensive right now compared to the deals he's finding in China.
We also have to mention Sable Offshore Corp. This is his smallest position at 0.7%. And man, it has been a rough ride. It's down nearly 37% overall.
Yeah, that hurts. It's trading at $11.02. The news suggests investors are getting skeptical because of political issues surrounding their offshore projects. It's a high-risk, high-reward play. But because it's less than 1% of the fund, it's not going to break him.
That's the beauty of this structure, isn't it? He has these massive, high-conviction bets at the top. Then these smaller lottery tickets or experimental positions at the bottom. Even with the portfolio down 4.5% today, he's still up nearly 8% overall.
It's a masterclass in concentration. He isn't diversifying for the sake of it. He has $3.5 billion spread across just a handful of names. He's looking for businesses with durable advantages, like East West Bancorp or PDD.
It takes a lot of stomach to stay down 21% on a $500 million PDD position. But his track record suggests he knows exactly what he's doing. He's not watching the daily tickers, he's watching the business results.
That's the key takeaway for our listeners. Lai Lu isn't trading. He's owning. Whether it's the stability of Berkshire Hathaway or the growth potential of Chinese tech, he's committed. He hasn't moved a single share in these top holdings recently. He was standing his ground.
It's a bold strategy in a market that feels more frantic than ever. Mike, thanks for breaking down these numbers with me. It's been a fascinating look at one of the sharpest minds in the game.
Always a pleasure, Sarah. It's a great reminder that sometimes the best move is to do nothing at all.
Thanks for tuning into our analysis of Himalaya Capital. We'll be back with more deep dives into the world's most successful portfolios. I'm Sarah.
And I'm Mike. We'll see you next time.
Thanks for listening to Portfolio Casts.
This content is for educational purposes only and should not be considered financial or investment advice.
Any figures, prices, or portfolio values discussed are approximate, based on public filings, and used for illustrative purposes only.
The views expressed are interpretations of public information and may not reflect the investor's current positions.
Follow Portfolio Casts for more investor portfolio breakdowns.